We hear it everywhere, right? Inflation. It seems like everything costs more these days. Groceries, gas, housing. It's a pretty common topic of conversation, for sure. But sometimes the conversation gets a little more complicated, and terms like stagflation, deflation, even hyperinflation start getting thrown around. So today we're going to try to make sense of all that. We'll take a look at what each of those terms actually means, what causes them, and what kind of impact they can have on, well, everything, really. And along the way, we'll begin to why stagflation especially is considered such a tricky economic problem to deal with. So if you're ready to dive in, let's get started. Oh, and if you find this episode helpful, do us a favor and hit that like button and subscribe to the channel for more deep dives like this. All right, so first things first. What exactly is inflation? In the simplest terms, it's when prices for goods and services across the entire economy increase over time, which means basically your money buys you less stuff than it used to. But here's where it gets interesting. A little bit of inflation, a low and steady rate of price increases, that's often seen as a sign of a healthy economy. It can go hand in hand with things like low unemployment and stable interest rates. So it's not always a bad thing. It's more about finding that balance, right? Now, to get a better grasp on inflation, we need to understand what drives it. And there are a couple of key factors at play. One is this idea of supply and demand. If everyone wants the same product, but there just isn't enough to go around, well, the price goes up. It makes sense, right? It's basic economics. Another big factor is the money supply. If the amount of money circulating in the economy grows faster than the economy itself, that can lead to inflation. And we measure the economy's growth by looking at something called GDP, gross domestic product, which is basically the total value of all the goods and services produced. So if the money supply outpaces GDP growth, well, you've got more money chasing the same amount of stuff, and that pushes prices up. And we've seen some pretty clear examples of these forces at work in recent years. Think about the supply chain disruptions we had after COVID. Suddenly, there were shortages of all sorts of things, and people were eager to buy stuff as things started opening back up. So you had this perfect storm of increased demand and limited supply, and prices, well, they went up. And then you had the oil price spike in 2022 after the invasion of Ukraine, which made things even worse. Oil is such a crucial commodity, and when the price of oil goes up, it ripples through the entire economy, pushing up the costs of almost everything. So it's a complex system for sure. And to add another layer of complexity, there are actually different types of inflation. One is called demand pull inflation, and that happens when the overall demand in the economy increases while the supply of goods and services remains relatively stable. So all that extra demand is pulling prices upwards as people compete for those limited resources. Then there's cost push inflation, and this occurs when the costs of production for businesses increase. Think about things like raw materials, labor costs, energy prices. When those costs go up, businesses often have to raise their prices to maintain their profit margins, and those higher prices get passed on to consumers. So the rising costs are pushing inflation upward. The classic example of cost push inflation is the oil crisis from the 1970s. When the price of oil suddenly spiked, it caused a chain reaction across the entire economy, raising costs for businesses and consumers alike. So the impact of inflation, well, it can vary depending on who you are and what your financial situation is. Certain groups tend to be more vulnerable to the negative effects of inflation. People living on a fixed income, like retirees, are a good example. Their income doesn't change, but the cost of everything keeps going up, which means their purchasing power shrinks. Investors holding long-term bonds can also be negatively impacted. They receive fixed interest payments, but as inflation rises, those payments buy less and less over time, eroding the real value of their investment. Another group affected by rising inflation is anyone with variable rate debt, like a mortgage or a credit card. When a nation goes up, central banks often respond by raising interest rates to cool down the economy. And that means higher interest payments for anyone with variable rate loans. Even the stock market doesn't escape the effects of inflation. Rising inflation can make investors nervous, leading to volatility and increased risk. So while some level of inflation is pretty much a constant in most economies around the world, those really intense periods of high inflation, well, we can stick around for a while. A prime example in the US is the Great Inflation, which lasted from 1965 to 1982. That's a pretty long stretch, and it really illustrates just how stubborn inflationary pressures can be. And when inflation isn't kept in check, or if it starts to accelerate, well, there are some significant risks involved. The most obvious one is the erosion of purchasing power. As prices rise, your money just doesn't go as far as it used to. To try to curb spending and cool down an overheated economy, central banks like the Federal Reserve often resort to raising interest rates. But while this is meant to combat inflation, it also makes borrowing more expensive for everyone, from individuals to businesses. And it's important to remember that there's generally an inverse relationship between interest rates and bond prices. So when interest rates go up, the value of existing bonds tends to go down. But perhaps the most concerning risk is this idea of a self-perpetuating cycle of inflation. If people and businesses expect prices to keep rising, they might start spending and investing more aggressively to avoid paying even higher prices later on. And this increased economic activity can actually further fuel inflation, creating a vicious cycle. Okay, so we talked about inflation, but what about stagflation? How's How's that different? Well, stagflation is a much more challenging economic situation. It's essentially a combination of stagnant economic growth and high inflation. So you've got the painting of rising prices happening at the same time if the economy is sluggish or even contracting, and unemployment is high. And to make matters even worse, interest rates often rise during stagflation as well. The key difference between regular inflation and stagflation lies in the overall health of the economy. Deflation can happen even when the economy is growing. In fact, as we discussed earlier, a little bit of inflation can be a sign of a healthy economy. But stagflation is this really nasty combination of high inflation with economic stagnation and high unemployment. It's a particularly bad environment for investment because businesses are facing higher costs for everything, but they're also seeing lower sales because the economy isn't doing well. And that leads to reduced profits, which is bad news for everyone. Now, what causes this dreaded stagflation? Well, it can be a combination of factors. One major culprit is something called supply shocks, which are sudden disruptions in the availability of essential commodities. The most common example is oil. If there's a sudden drop in the supply of oil, it can push prices up because there's less oil available, but it can also hurt economic activity because oil is such a vital input for so many industries. And then there are the policies put in place by governments and central banks, which could also contribute to stagflation. Fiscal policy refers to how governments manage their spending and taxes, while monetary policy deals with the money supply and interest rates. If a central bank, like the Federal Reserve, raises interest rates too aggressively to combat inflation, it can actually slow down the economy too much, leading to stagnation. And a classic scenario for stagflation is when you have a low supply of key commodities happening at the same time as the central bank is raising interest rates, with a double whammy for the economy. And the consequences of stagflation can be pretty brutal. People face a much higher risk of losing their jobs, and those who manage to hold on to their jobs might see their wages stagnate or even decline. All of that leads to a drop in consumer confidence, which further weakens the economy. Businesses get squeezed from both sides. They're dealing with higher costs for their raw materials and other inputs, but at the same time, demand for their products is falling because the economy is weak. This puts a real strain on their profit margins and can even lead to a decline in their stock prices, which hurts investors. And while typical periods of inflation might last for years, stagflation tends to be shorter-lived, usually lasting for a few months, maybe one or two economic quarters, but unfortunately, in some cases, it can drag on for much longer. A prime example is the period from 1973 to 1982, when many economies around the world experienced prolonged stagflation. It was a really tough time, and it shows just how challenging it can be to get out of a stagflationary spiral. The risks associated with stagflation are pretty serious. Like regular inflation, it erodes your purchasing power as the cost of everything keeps climbing. But the real danger with stagflation is that when the central bank tries to fight inflation by raising interest rates, it can actually make the economic slowdown even worse, putting even more pressure on consumers who are already struggling with debt and a weak job market. And for businesses, the combination of higher costs and lower sales is a recipe for lower corporate earnings, which can further depress stock prices. And to try to stay afloat in a stagflationary environment, businesses might have to make some tough decisions, like cutting costs by laying off workers. And that, of course, leads to even higher unemployment, creating a vicious cycle. Now, before we wrap up, let's touch on a few other related economic terms that often come up in these discussions: deflation, disinflation, and hyperinflation. Deflation is essentially the opposite of inflation. It's a general decline in the prices of goods and services over time, and it usually happens because there's less money circulating in the economy or a decrease in the availability of credit. Disinflation, on the other hand, is a bit trickier. It's often confused with deflation, but it's not the same thing. Disinflation doesn't mean prices are falling. It just means that the rate at which prices are rising is slowing down, so prices are still going up, just not as fast as they were before. Finally, we have hyperinflation, which is the most extreme and worrisome type of inflation. Hyperinflation is when prices skyrocket incredibly rapidly and a country's currency loses its value very, very quickly. It can completely destabilize an economy and lead to all sorts of social and political problems. So just to recap, we've learned that while inflation is a general increase in the prices of goods and services in an economy over time, stagflation is a much more problematic situation. It combines high inflation with slow economic growth and high unemployment, creating a really tough environment for individuals, businesses, and policymakers alike. We've also seen that while a low and stable level of inflation is generally considered a normal part of a healthy economy, stagflation is widely seen as a serious economic challenge that requires careful attention and a multifaceted approach to address. Hopefully, this discussion has shed some light on these complex economic concepts and giving you a better understanding of how they can impact your own financial decisions and your understanding of the broader economic landscape. As always, thanks for listening. And before you go, if you found this episode informative, please hit that like button and subscribe to the channel for more deep dives into the world of economics and finance. Until next time, take care.